Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. As many of you are aware, the SBIA is the Advocacy Association for investment professionals focused on America's lower middle market companies. Our association has played a pivotal role in promoting the growth and vitality of this industry and the small businesses it supports for more than 60 years. We're very pleased to bring you our Lunch and Learn webinar series with today's topic, the CARES Act and related COVID-19 tax considerations. This is our first in a series of educational webinars designed to provide useful educational content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. Just a couple of housekeeping items before we get started. If you have questions for our speakers, please send them by email to info@sbia.org. That's info@sbia.org. Also, if you are having technical difficulties, please note the chat feature in your menu bar on this meeting platform. Our technical director, Ali Kaunaki, will be monitoring that feature for any technical issues you may have. Today's session is possible due to the support of our longtime sponsor, Winston & Strawn. Winston & Strawn is a full-service law firm with 1,000 attorneys and 16 global offices. Today, we welcome two professionals from the firm who will graciously share with us their expertise on this important topic. Joining us from Chicago is Olga Loy. Olga is a partner and co-chair in the firm's tax practice, where she concentrates on tax and structuring aspects of private equity, venture capital, and SBIC fund formation. Olga also helps her clients complete complex business transactions, including mergers, acquisitions, buyouts, recaps, debt and equity restructurings, and negotiates executive compensation. Joining us from the firm's Washington, D.C. office is partner Ruth Weimer. Ruth is an attorney and CPA with over 30 years of experience. She focuses on matters related to executive compensation, employment taxes and payroll, fringe benefits, and qualified and non-qualified deferred compensation. Contact information for both Olga and Ruth will be provided at the end of the presentation. Thank you, ladies, and if you are ready to get started, I will turn the virtual podium over to you.
Well, thank you so much. This is Olga Loy. I just wanted to say thank you everyone for joining and welcome to our presentation. I missed seeing all of you in Chicago at the SBIA conference, but hope to see everybody at the Breakers and in October. We're going to do a presentation today on the CARES Act tax provisions. If you could go to the next slide, please, I will outline what topics we're covering here. Next slide. So as you all know, in March of this year, March 27 to be precise, the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, was signed into law to provide nearly $2 trillion in aid and relief to individuals, businesses, and other entities affected by the pandemic. We're going to focus here primarily on how the law has affected funds and their corporate portfolio company, and to some extent, partnership portfolio company, because they could benefit significantly by the act, and there are certain pitfalls that we want you to be aware of. So the topics that we're going to cover today is NOL carrybacks and relaxation of carry forward limitation, more liberal interest expense deduction limitation in 2019 and 20 and how it interplays with NOL carrybacks, certain expensing of qualified improvement property, which is called technical correction of a glitch, and then Ruth will cover provisions that are more related to the payroll tax, retention credit, mandatory paid sick leave, and other provisions. So we will launch right into the income tax provision. So next slide, please. Okay, so net operating loss and why that's important. This I view as by far the most important provision that will affect corporate portfolio company that could provide significant benefit and provide some additional liquidity at the time when companies are in a loss position. So what CARES Act did is that there are number of changes to the rules regarding the use of net operating losses, and most notably is allowance of carrybacks. The CARES Act provides taxpayers a 5-year carryback period for net operating losses arising in tax years beginning after December 31, 17, and actually it should be corrected on the slide, and before January 1, 2021. So basically for calendar year taxpayers, years 2018, 19, and 20. Prior to the enactment of the CARES Act and pursuant to the tax reform in the 2017, the Tax Cuts and Jobs Act, NOLs arising in those years could be carried forward indefinitely, but could not be carried back to prior tax years. So taxpayers may now elect to relinquish the entire 5-year carryback period with respect to particular year NOLs, with election being irrevocable. So the benefit of this provision is that now we have the carrybacks. So those carrybacks are particularly valuable to corporate taxpayers that had income that may be offset in 2017 and prior years, when the corporations was subject to a higher tax, which was 35%, rather than the current 21% corporate tax rate. So one catch is, though, corporations that were profitable in 18 and 19 and are only in the last position in this year must wait until the end of the year to claim the refund that would be attributable to NOL carrybacks. So this is the benefit. So the next slide, please. So additional NOL benefit provision is the removal of 80% of taxable income limitation on the use of the NOLs. The CARES Act allows corporate taxpayers to use NOLs to fully offset taxable income, again, for tax years beginning before January 1, 2021. Under the prior law, NOLs arising in tax years beginning after December 31, 2017 could be only used to offset 80% of taxable income in any year to which they were carried. So the CARES Act suspended the prior law's taxable income limitation on the use of the NOLs for tax years beginning before January 1, 2021. So now the CARES Act permits corporate taxpayers to use NOLs to fully offset taxable income in those years, regardless of the year in which the NOL arose. So if you think about this, now we have 3 buckets of net operating losses. I think about this. So if we have net operating losses that are generated in tax years that begin before December 31, 17, so the December 31, 17 NOLs, they're eligible for 2-year carryback and 20-year carry forward. So now we've got second bucket, beginning after December 31, 17 and beginning before January 1, 2021. So in this time period, we've got 5-year carryback and indefinite carry forward. Now, the final bucket, beginning on or after January 1, 2021, no carryback and indefinite carry forward. So it's rather complicated, and you really have to think about what year the NOLs has arose for your portfolio company, so to figure out what carrybacks and carry forwards are available. So next slide, please. Another provision that was put into place is interest expense deduction limitation. And I remember at our SBIA conferences and meetings, when this limitation was put into place, we all discussed how it's going to affect portfolio companies. As you recall, interest expense, the limitation was put in place equal to 30%. And that 30% limitation, we discussed it at the prior presentations at the SBIA meetings, how it's going to affect portfolio companies. So now the limitation on the deductibility of interest expense is now based on 50% rather than 30% of adjusted taxable income for tax years beginning in 2019 and 2020. Adjusted taxable income is generally computed in a manner similar to EBITDA, but is based on tax rather than book amounts for tax years beginning before 2022. So another benefit that was put by the CARES Act is that taxpayer may base its limitation for tax year beginning in 2020 on its adjusted taxable income for last tax year beginning in 2019. So effectively, this allows taxpayers to choose the higher of their 2019 or 2020 adjusted taxable income. So those provisions of benefit, and we think that you should consider with your portfolio companies how those provisions will affect them going forward. Next slide, please. As if things are not complicated enough, this relaxation of interest deduction limitation provision does not apply for partnerships tax year beginning in 2019. So for partnerships have to continue to compute their limitation based on 30% of adjusted taxable income for 2019 tax year, and can only compute and apply the 50% limitation for their 2020 year. However, partners are permitted to treat 50% of their allocable share of the partnership's 2019 excess business interest expense as paid or accrued in 2020. And such business interest expense is not subject to any further 163J limitation at the partner level. So just take a note, this is a complicated provision to the extent that you have a portfolio company that is a partnership, rules different from corporate interest expense limitation are applicable. So where does it leave us with all of the rules and all of the relaxation of the rules and the NOL carrybacks? So basically, what happens is that these rules, they provide for avenue for liquidity for corporations that expect significant tax losses in 2020 as a result of the pandemic, although a large portion of that liquidity may be deferred until corporations will file their 2020 tax returns. But to the extent that you have some NOLs that you could carry back and obtain refunds for tax years 2015 through 2019, you should definitely look into this and see if you could find some liquidity now by looking to those refunds. So that's kind of where it leaves us with the NOLs. Next slide, please. So another provision that is a benefit under the CARES Act is a provision related to qualified improvement property. So what is all of that about? So the qualified improvement property was intended to have a 15-year depreciable life that would allow taxpayers to deduct 100% of capital expenditures made on these improvements under the expensing provisions of the Tax Cuts and Jobs Act, the prior act. So, but there was what is called a glitch that lay in the fact that the legislation failed to assign qualified improvement property a 15-year depreciable life. That means that such improvements were treated as having a 39-year depreciable life, and therefore they were not eligible for immediate expensing. So the CARES Act fixed this retail glitch and allowed taxpayers to fully deduct expenditures made on qualified improvement property. So the effective date of this provision is retroactive, as if it was included in the prior act in 2017. So that's another provision that could affect you. Next slide, please. I think we're actually to the end of my slides, and the last slide, what I wanted to kind of what should we do? You know, of course, you will review with your portfolio companies what net operating losses are available, what you can offset, and what kind of carrybacks you could get. But what happens if you are doing a transaction now, or if you have done a transaction in the last couple of years? What do you do now? So what we have told the clients, that if you have had a corporate transaction where your fund acquired a portfolio company that is a corporation, you should carefully review who has the benefit of those net operating losses. You know, because obviously, let's say you negotiated this transaction a year and a half ago, nobody knew that this law was going to be in place. So you should carefully review who has the benefit. Is it the buyer? Is it the seller? Who is entitled? You know, is the company entitled to carry back NOLs? And if you do carry them back, who is entitled to the benefit of those NOLs? You know, obviously that wasn't taken into account when you negotiated your purchase agreements. So you should review them carefully and make sure that, you know, you're aware as to who has the right to those refunds. And then to the extent that you are negotiating any purchases now that you're looking to buy or sell portfolio company, depends on whether you're a buyer or seller, you might consider including certain covenants and indemnities in your purchase agreements, and perhaps having prohibitions on amending pre-closing tax returns, prohibitions on carrying back NOLs to pre-closing periods. You might want to have indemnity for clawback of tax credits, and Ruth will talk about it. So credits taken when PPP loan is obtained. And then just think about whether NOL carrybacks may make sense as a general matter, and the benefits of those NOL carrybacks should be subject of negotiation when you are working on a purchase or a sale of your portfolio company. That's kind of my part. I don't think we have any questions, but Ruth, I don't know if you have any questions for me at this point.
Oh, I think I do, and actually 2 questions. If the agreements are completely silent, which way do you go as to who gets it? And then also, just from a strategy standpoint, does it help if you analyze your tax rates in those prior years? And if the tax rates were lower or they were higher than what you see coming up, would that make it more beneficial or less beneficial to go back and use? In other words, it's elective to go back and use these operating losses, and does it require mathematical analysis as to whether it'll do you better to go back than to go just use it forward?
Right, right. So, I mean, the question is, who gets it if the agreement is silent? Typically, purchase agreements will have complex provisions that say who pays pre-closing tax, and so, and then who is entitled to, you know, basically, typically, you would say, okay, if you are the seller, you know, you sold a portfolio company, you will have cutoff. So you have pre-closing tax periods and you have post-closing tax periods. So as a seller, you would be responsible for pre-closing tax. And, you know, but as a buyer, you now have control of the portfolio company. So if you have a portfolio company, you know, you could file the returns, you could amend the returns, and if there's nothing that, you know, in the purchase agreement that says you cannot amend the returns, you could amend them and, you know, technically do whatever you want with the portfolio company. But you have to be careful in making sure, because sometimes tax is taken into account in determined working capital adjustments, and you just have to really be very careful with those provisions and see how all of those things are defined and how they are calculated. Because even though as a buyer you will have a control of the portfolio company now, you might not get the full benefit of the, you know, of those refunds, depending what your purchase agreement says. So that's kind of it, you know, the lawyer's answer is it depends. And then, you know, the second question where you said, do we have to do a calculation and analysis? I would say yes. I mean, of course, it's impossible to know if your company is going to be profitable next year, how things will turn out. What's a bigger benefit? Do you carry back the net operating loss to a prior tax year, and especially to a tax year where corporate income tax was 35%? I would say yes, but what happens for next year? First, is the company going to be profitable? And second, I don't know what kind of corporate tax rate we're going to have next year. It could still be 21, it could be 35, it could be even higher. So this analysis, should be undertaken, but there's a lot of uncertainty in determining what is the best course of action. But good questions.
Yeah, good answer. Good answer.
Thanks.
Okay.
I think I'm turning it over to you, and you will talk about things that was on everybody's mind and kind of all the action items for portfolio companies and also for the management company of the funds as we talk.
Correct. So we're on to the next slide. This is Ruth Weimer, and as I was introduced, I've worked in the executive comp and qualified plan area and payroll for numerous years. And so when the CARES Act came down the pike, trying to help companies that were being affected by the pandemic, Congress saw fit to add some dollar-for-dollar benefits for employers who found themselves in situations that they were paying employees who were not working or had various problems related to the pandemic. And so my first topic, I'm basically going to be addressing two different types of credits. And one is the first one has two different components, the mandatory paid family leave and sick leave. That's my first discussion, and then I'll get to the retention credit. And these two groups of credits are so very different. They begin, the first category of credits, which is the family leave and sick leave. The first thing to know, it's for pay that occurred after April 1st, 2020. So it's been around for a while. Next slide. It's always important to start with the primary qualifier to get these credits. And the first thing to know, because this rules out an awful lot of companies, is that the family leave and sick leave credits apply with employers who have less than 500 employees in the US at the time the leave is taken. Now, if any of you on the phone, on the webcast are tax people, you know that normally criteria is based on a control group basis. Well, for these credits, it is not. So the first thing to know is if you have a management company that has less than 500 employees or a portfolio company that has less than 500 employees, this credit applies and generally is not on anything but a legal entity by legal entity basis. The credits were viewed initially as somewhat of a negative because what they require is that an employer pay employees who are on family leave or sick leave. And so most employers were like, geez, I'd like to be more than 500 employees because I do not want to have to make these payments. But on further analysis of how the CARES Act worked, most employers say we want to be eligible for the requirement of making these payments because when we do, we get reimbursed dollar for dollar of every payment we made by the federal government. So it's generally reviewed as a positive to have the requirement to make these payments apply and then have the ability to get reimbursed by the federal government because your employees are being paid in situations where they wouldn't be otherwise. And that keeps you with a happy group of employees. Next slide. Yes. Now, how do you determine the number of employees? Because this is a very, very critical issue. Early on, everyone was confused, and then there was contradictory guidance that came out. But the judgment of the 500 employee rule is you normally look at a single entity basis unless the integrated employer test or joint employer test applies. An integrated employer test looks at the factors of, is there an interrelationship of operations, common management, centralized labor relations and personnel, and common ownership and financial control. And some of you management companies might say, oh, well, we have common ownership and financial control of the companies that we own, and therefore we're going to bump up over the 500 employee threshold and not be able to get this credit. But when you look at DOL guidance on this, because the guidance is with the Department of Labor, they say common ownership is not the most important factor and is hardly a factor at all. The joint employer test basically boils down to when two different companies have common control over the same person. So it'd be like subsidiary 1 and subsidiary 2 both commonly employ an individual. Then you would have to count those employees for each of those companies for that 500 employee threshold. And again, that normally is not the case. So my takeaway on how do you count your 500 employees for purposes of the ability to get the credit is you can pretty much stick with it's on a legal entity by legal entity basis, even if it's disregarded entities. It's a company that's owned 100% by another company. Next slide, please. The other employees that are included in the 500 employee count are those that are on leave, and temporary employees and part-time employees are counted as full-time. But excluded are furloughed or laid off employees until return to employment. And the judgment is made at the time the company wishes to take the credit or the employee takes his time off. And you'd say, why is this relevant? Well, it came up as being very important that furloughed or laid off employees don't count because we have a lot of companies out there that might have 1,000 employees or 600 employees going into the pandemic. And then they find they have to lay off people. And now they find they're at 500 employees or less. Well, if today the company got small enough that it's under 500 employees, now they must, they're obligated to pay the family leave and the sick leave. But again, as I said, no problem there because they get every single dollar back from the federal government. Next slide. For family type leave, there's two, as I said, there's sort of two different categories here. For family type leave, there's a maximum credit of $200 a day, and that's all you need to pay these people who are on the family type leave. These are people that are caring for an individual subject to a federal, state, or local quarantine order or advised to self-quarantine, or caring for a child if the child's school or child care facility are closed. Well, of course, there was plenty of people in those categories over the last several months, especially while schools were still in session. And so those parents that had to stay home to take care of the children, or unfortunately had to take care of someone who was quarantined by federal or state or local mandate, or advised to self-quarantine by healthcare provider, those individuals who weren't able to work because of those situations, they're entitled to $200 a day. It's roughly speaking, I call this babysitting money. Next slide, please. The maximum credit is 2/3 of each employee's regular rate of pay up to $200 or $10,000 in the aggregate with respect to all calendar quarters. That's 10 weeks. It's better than the mandatory paid sick, which is only 10 days. So however, the two leaves fit together for the child care. So you first get 10 days of the sick leave for the child care and then family leave for the next 10 weeks thereafter. Next slide, please. There is paid sick leave with a maximum credit of $511 a day, up to $5,110. It's available for employees who are out of work because they are subject to federal, state, or local quarantine or isolation order related to COVID-19, have been advised by healthcare provider to self-quarantine, or experiencing symptoms. So then again, with similar to the family leave, you get the sick leave of 2/3 of each employee's regular rate of pay at the $200 when you're caring for someone else. So the sick leave is higher when, just conceptually, when you, the employee, are quarantined or you are sick or you're waiting to find out if you're sick, you get paid handsomely. The amount of pay is reduced to only $200 a day when you're basically taking care of someone else, babysitting, taking care of an individual, or providing childcare to your own children. Next slide, please. And don't forget to remember the big picture, which is you look at company by company, and if a company is 500 or less employees, you must provide this leave. When someone has to take care of their child or they themselves are sick, you have to provide this paid leave. But on the other hand, you say this is a good thing because federal government is going to pay you dollar for dollar. The credit is limited to 10 days of combined sick leave, even if the 10 days do not add up to the hours required under FFCRA. And as I stated, the first 10 days of the child care type leave is also covered by the paid family leave for an additional 10 weeks. So the Internal Revenue Code says you get 10 days under one provision and another 10 weeks under the DOL provisions, paid leave. And just a little flavor on this, this is the first time ever there has been a federal mandated paid leave. Most people think there already were, but there wasn't. The federal government said if you must take time off for certain family related reasons, such as pregnancy or you're sick and so forth, you get a little time off, and this basically applies to larger employers. You are guaranteed time off, but without pay. With the CARES Act, for the first time ever, there is time off with pay. And the time off with pay from the Department of Labor is for child care. Again, schools are closed, and or your child care provider is not there. Now, what you would say, geez, this is a pretty dry topic. There can't be anything funny about this at all. But in sort of reviewing the rules for purposes of this presentation, I went back and I was looking at the Q's and A's from the Department of Labor and IRS about what are the exact requirements for providing this mandatory paid time off and the cash payments that are then reimbursed by the government. And to me, it was very humorous because you again, for the child care type leave, you get 12 whole weeks. That's a long time. For all the other leaves, you just get the 10 days. But in order to validate for the child care type leave, they said, oh, you have to say why you have to stay home to take care of your child, why you should be getting these payments. And then it goes on to say, if the child is a teenager, you have to state why you have to stay home to take care of this child. And I say to myself, everyone knows teenagers are less trustworthy to leave home alone. Of course you have to stay home to take care. Okay. I think we're ready for the next slide. Now, how do you get your money if you're an employer and you have less than 500 employees and you're required to pay people when they're not working because they're quarantined, they're sick, they're taking care of someone? How do you get your money back? And while Olga was talking really about tax deductions, you have now what I'm talking about is tax credits. Why are tax credits better than tax deductions? Well, tax deduction would say if you had $1 million of income and you get a tax deduction, that means that you can subtract that from your total taxable income, and the taxes that would otherwise be due on that $1 million are now not due. Well, a credit is that on steroids, because a credit says if you have $1 million credit, that means you're getting $1 million. You don't have a deduction. You're just saying, hey, I have a credit, and I for $1 million, I paid out family, medical, and sick leave up to $1 million. I want that money back. And so the IRS says, we will get you your money back. And the way that we do is from your payroll taxes. And the CARES Act said, oh, you get the credit against your, basically your Social Security taxes that you pay as an employer on your 941 every quarter. You make deposits and you tally up at the end of a quarter and say you owe money in or you overpaid. And to get your reimbursement for your family leave and sick leave payments, you say, okay, here is, I get out my calculator, I add up that I like to use $1 million because I have plenty of clients that paid out $1 million on these provisions. You say, I owe $1 million. I mean, I am entitled to $1 million. And when I look at my employment taxes for FICA, and the IRS expanded it to taxes owed on the basis of being withheld from employees' wages on everybody's wages, you get to take the credit against that. So that means what I call the immediate gratification system of getting this credit. These credits are refundable. So that means even if the employer never had to pay in FICA taxes equal to that amount, the government owes them that $1 million. So if the FICA tax liability was 0 and the credit was $1 million, the government would have to give a refund. So the government says, we're going to set up systems. When you do your employment tax return, you can just subtract out what you were obligated to pay in, and therefore keep your own money in your pocket. Next slide. Now, there's an important qualifier for purposes of the paid family leave and sick leave, and that is that when these individuals are taking time off because they themselves are sick or they're caring for someone else, there has to be work available for them. So if the business was shut down and they didn't have work, it can't be for that reason the person's staying home. They have to have work there available for them, but they're unable to do it because they're taking care of their child or they themselves are sick or one of the other family leave and sick leave reasons. And later I'm going to get to the retention credit, where in that instance, you will be able to get a credit. It's a very different type of credits. So family leave and sick leave is for where there's work there, but you're homesick or caring for someone. The employer gets a dollar for dollar credit, but there has to be work there. In other words, if the operation shut down, you're out of luck. Next page, please. These family and sick leave credits are taken all the way from April 1st through the end of the year. So be on the lookout for situations where this is available, because again, as I mentioned, you're looking for 500 employee or less count, and it could be that operations are smaller or one of your subsidiaries becomes smaller because of furloughs or layoffs. Then you can run in and grab this credit for people who have to take this kind of time off. There's some interaction with other code sections. If you're already taking a 45S credit, you can't take this one too. These payments that are made for family and sick leave are not subject to Social Security taxes, and the credit includes the employer share of Medicare tax and health insurance benefits. So all that's saying is, if you make these payments, you're going to be made 100% whole, even for the Medicare tax. You relieve the Social Security taxes for these people who are homesick or caring for others, and you can even pay for their health insurance and get reimbursed by Uncle Sam. Next page, please. Now, on the mechanical part, as I indicated, this is refundable credit, and the notice 2020-22 tells you how to get it. And as I indicated, it says you can go ahead and reduce your deposits for all your employment taxes. The CARES Act itself said, oh, this is a credit against employer Social Security taxes, but as I will state later, there's an ability to defer the employer Social Security. So this notice says, just like one of the fundamental things that you learn is money is fungible. So if I, the employer, am entitled to $1 million credit, but I owe $1 million of other taxes, the federal government can say, okay, no, I'll offset what you owe me with what I owe you, and you can keep your money in your pocket. So you can immediately reduce all deposits for employment taxes, or you can file Form 7200 to claim the credit independently of messing around with employment tax deposits. You just file this form and say, here's what I paid out. Please give it to me. Give me a reimbursement of this money. Or 3, you can request it when you do the Form 941 quarterly employment tax return for refund or credit for future obligations. So there's several different ways to go. Now, so that you feel like you really learned something from this presentation, I will tell you the very best way to go is to keep it clean and just file the Form 7200 to claim the credit, because that reduces your exposure to potential penalties. If any of you work with payroll taxes, you know, if you don't do your deposits of all your employment taxes correctly, or you ask for a credit against future employment tax obligations, and you made a mistake, you can get a lot of penalties. So let's say you say, geez, I thought I was eligible for the family and sick leave credits, and you claim it by reducing employment tax deposits, and you were wrong, you potentially could have some penalties. The best way to do is kind of keep it clean and just file Form 7200 to claim the credit. Next slide, please. Now we are on to the employee retention credit. And this one is the polar opposite of the family and sick. Family and sick is you have to be under 500 employees, and you have to have employees that are helping their children, taking care of their children, or they themselves are sick, or there's some quarantine, very pandemic related situation going on. The retention credit is very different, and superficially, the retention credit really can be obtained by most employers. And it's effective for employment tax deposits made after March 13th, 2020. So it goes back a ways. And by reviewing your payroll records, you might find that you are eligible for some of this credit. Next slide, please. Now, who is eligible? Any employer whose business is fully or partially suspended due to a government order related to COVID-19 or experiences a significant decline in gross receipts. So this is what we call the gateway to getting the retention credit. A significant decline in gross receipts means when the gross receipts are down by 50%. And then once you go back up to 80%, you no longer have that qualifier. But remember, you have 2 different bites at the apple. The first one is, and this is, I would say a good portion of companies in the United States have been at least partially suspended due to a government order related to the pandemic. Next slide, please. What is the amount of the credit? It's not huge, but it definitely can add up. You can get a credit of 50% of employee qualified wages up to $10,000 per person. And thus the maximum credit is $5,000 because you get 50% of $10,000 of wages. Next slide, please. Now, does size make a difference? Does the number of employees make a difference? It does on how wages are calculated. And I think for those listening in, you're going to have some of you possibly could be in the under 100, but probably not many. Because unlike the family and sick credit, for determining some of the mechanics of the retention credit, of 100 employees, which is a low number, and furthermore, you do it on a control group basis. So that means if you have parent sub situation with 50% common ownership and control, you have to add those all up, and it's likely that most of these control groups will be over 100 employees. That doesn't mean you don't get the credit, because most companies are getting this credit. It just means you have to look at different people and getting the credit. So if you have over 100 employees, which I'm going to guess it on a control group basis is most of you, you only get the credit for the wages and health expenses paid to employees who are not providing services, who are not working. If you had 100 or fewer employees, you get the credit for people who are even fully working, telecommuting, whatever. You would still get the credit for paying them their wages. But for most employers, again, those with over 100, it has to be people are sitting at home. There's not enough work to do. And, your operations have been fully or partially suspended, or your profits are down, and these people have nothing to do, and you're paying them anyway. At least in that situation, Uncle Sam helped you out to the tune of 50% for the first $10,000. You look at your 2019 numbers on a control group basis to determine whether, the mechanics of whether you're over or under 100. So it's not like the family and sick that if you drop below, you're good, you just, whatever it was last year, you're kind of stuck with. So essentially the takeaway here is you still get the retention credit. It's just that it's only for people that you're still paying when they're not fully working. An example might be your admin staff isn't coming into the office, but you're still paying them for 5 days a week and they're only working 2 days a week. That would be an example. And then you get the credit once you get the credit 50% from the wages paid during the 3 days that they're not working. It's kind of like is found money here because the government's paying dollar for dollar. Next slide, please. So the IRS has lots of FAQs on this guidance, and it's been a political hot topic. And there's a lot of employers who were affected by the pandemic in their operations, and they laid people off temporarily, but they kept on paying their health insurance. And the IRS first said, you cannot get the credit for the health insurance. And there was such a hue and cry over this that Congress wrote Treasury and said, you better change that back. And so now if your employees are not working because the company operations are affected and you don't have work for them, but you pay for their health insurance, you can get a credit for that. So that's a great thing. But the IRS also had in their frequently asked questions, they said, if you use pre-existing paid time off to make these payments, you can't get the credit for that. That particular guidance, I think, is without a statutory basis. And that's what the IRS has written. I think if you didn't follow that rule, in other words, you had employees who say, geez, you put me on a reduced schedule. I would only get paid for 2 days. I want to use my vacation or other paid time off for the other 3 days. The employer can pay that and get the credit for that. That's my read of the CARES Act clearly. But you are facing the fact that at this point, at least, the IRS is saying you cannot, but it's only FAQs, and that's not substantial authority. Okay, How long can you get this credit? It's available for qualified wages paid from March 13th to the end of the year. And be aware people are returning to work. So maybe once the company is fully up and running, you don't have the gateway to getting the credit. In other words, if your operations are no longer affected, you're not going to be eligible for the retention credit. Next slide, please. Interaction with other code provisions. The employee retention credit cannot be granted on the same wages as you got for the family and sick. And I would say you wouldn't have it on the same wages, because if someone is taking the sick leave, it has to be in a situation where there is work for them, and you only do the retention credit where there isn't work for them. So I think they're kind of mutually exclusive. And the retention credit is not allowed with respect to certain individuals that are related to the taxpayer. So if you had a really closely held company, if it can't be for your son or your spouse. Next slide, please. Those employers, and I think this may be a bit of interest to many of you listening in, is employers who receive a small business loan under the SBA Paycheck Protection Program are not eligible for this credit. There may be recapture if the retention credit is taken prior to receipt of the PPP loan. That's exactly what it says in the statute. And remember, the big picture is the retention credit is on a control group basis, and the family and sick is not on a control group basis. So looking at the retention credit, this prohibition on the receipt of the loan, if you had one company in the control group that got the loan, all the other companies are out of luck. So Olga and I were just chatting a little bit about this. I said, you really, if you have a control group, you may say, we don't want that retention credit for $100,000 if it's going to mean losing $1 million of retention credit. And Olga, who does a lot of transactions, big transactions, say, geez, are we going to buy this little itty bitty company that got the retention credit and or that got the loan, and means that we have to get, we're going to have to pay the government back on our retention credit because we already took it. You'd have to do some heavy thinking about that. So those two interact with each other. Next slide, please. So here's some of the penalties that can apply if you go to get either your family and sick leave credit or the retention credit. So remember, the ordering rule is you first get your family and sick leave credits, and then you get your retention credit against your employment taxes owed to the government. But you could go ahead and get both on your Form 7200, which is my suggestion. You don't mess around with employment tax deposits. You just go straight for both of these credits on the Form 7200. You could have interest on underpayment, failure to pay, failure to deposit, failure penalty on underpayments, collect to pay over tax, or erroneous claim for refund or credit. None of those apply if you go the Form 7200 route, unless 3 years down the road, the IRS says, you asked for credit on your Form 7200. We don't agree. If you go ahead and pay it back, then you'll have none of these penalties. Whereas if today you curtail employment tax deposits trying to get an immediate refund of the retention credit or family and sick leave credit, these penalties could apply. Next slide, please. Then delay of employer payroll taxes. That was effective March 27th, 2020. This one I would call the no-brainer. Next slide, please. This is not a credit, so it's not nearly as interesting, but it's pleasant for all of you who are very familiar with the time value of money. To the extent you have payroll obligations, and employer Social Security taxes are owed, of course, on payroll. The CARES Act said we are going to give every employer, every single employer, a break, and we give you a interest-free loan of you don't have to pay in your employer's Social Security taxes that are owed for this year. You can delay and pay 50% of it by the end of next year and the other 50% by the end of 2022. So for those companies that say, geez, we need a little more cash flow at the moment, you can simply stop making your deposits and payments, and no bad things will come to pass. And it's not hard to do. And as far as I know, I think most companies are taking advantage of this. And then here's some good news. In the CARES Act, said, well, you can do this deferral as long as you don't get loan forgiveness under the Paycheck Protection Flexibility Act. That's loan forgiveness. And so a lot of employers were like, geez, we how come, we want to defer Social Security taxes even if we get loan forgiveness. Give us a break. And so the Flexibility Act, Paycheck Protection Flexibility Act, which just passed in the last 2 weeks, I want to say, said, okay, you still can get Social Security deferral of the employer obligation, even if you get these loans forgiven. So one less thing to worry about, and one more opportunity for companies who would like, who have cash flow problems. Next slide. Let's see here. The deferral only applies to the employer's Social Security tax. The employers could begin deferring from March 27th, 2020. And they're doing the 2 installments, 50% at the end of next year, 50% the year thereafter. Really no penalty exposure here, because it's not nearly as gray of an area. It's not gray at all. Unlike the retention credits and maybe the family and sick leave credits, where there's some interpretation involved that that you have to get around, that you have to be happy with, let's say, in order to get those credits. With the employer Social Security deferral, it's pretty straightforward, black and white. And like I said, I think most companies are taking the deferral. Next slide. Just a few words on executive compensation. Next slide. Both Olga and I work with executive compensation, and I had one organization want me to give a presentation on executive comp, and I said, there really isn't that much with respect to the CARES Act. If you got a CARES Act Roman numeral 4 bailout, that limits executives on how much they can be paid in the future. So that's not the PPP loan. That's a different kind of bailout that unless you have that, you don't need to worry. And plus, the amount executive comp you can pay is extremely high, millions of dollars. So there's not much of interest there. If you got an SBIA loan, the amount you can get of forgiveness is limited to $100,000 for each of the executives during the 8-week period at the rate of $100,000. So that just means the government's not going to subsidize the wages to executives making $1 million a year. The government's only going to forgive the loan for basically around $15,000 for those high-paid executives. The issues that you see are Section 409A, deferred compensation issues, and so forth. And you can stop your deferrals in a 401k plan if you have a hardship, and otherwise stopping deferrals or getting distributions are only okay if there's a severe financial emergency. But so it's basically executives deferring comp. If they change their mind, they're probably not going to be permitted to change their mind on their deferred comp plans. Okay, with that, I think we are drawing to a close here. And you've been a wonderful audience.
Ruth, I think, yes, we have just 1 minute. And then in terms of the question that we talked about, that if the company is being purchased and they have, you know, at the time when before the purchase, they were eligible for the PPP loan or any kind of a credit, and then together with the acquirer, they're not eligible. So what happens?
Unfortunately, the way the law is written right now is it says if there's any company in the control group that gets the PPP loan, then gets the loan, then no company in the whole control group can get the retention credit. And so I think employers are looking for some kind of relief, but at this point, you'd be out of luck. And it may well be, if the retention credit was already taken, that money will have to be paid back to the federal government. So it is a little scary, and something to keep in mind in doing an acquisition. If one of the companies being acquired did get a loan, it could mean that any retention credits taken will have to be paid back.
Okay, thank you. I think we're done.
Yes, I think we've reached the end of our time. Thank you, Olga and Ruth, for sharing your insight and analysis. I think you've done such an excellent job that no one has any questions right now, and we are at the end of our time. So I'll just note that both Olga and Ruth have generously agreed to respond to any questions that we were not able to get to in writing. So you can reach out to them either at the information directly on this slide, or you can send your questions to info@sbia.org. But again, Olga, Ruth, thank you. We appreciate the time and the expertise that you shared with us today. We will have a recording of this webinar along with presentation materials that we will share with SBIA members. If you're not an SBIA member and would like to learn more about joining our organization, please contact my colleague, Alex Frick, at 202-628-5055 or email membership@sbia.org. And finally, in closing, we ask that you please mark your calendars for our next Lunch and Learn session, which is scheduled for next week, Thursday, June 25th at 2 p.m., where we'll cover investor transparency as a differentiator, managing LP relationships in uncertain times. Thank you again for joining us today.